Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Becton Dickinson and Company quarterly report. Becton Dickinson and Company offers a wide range of medical supplies, devices, laboratory equipment, and diagnostic products for various industries and individuals worldwide. The company operates through four main segments: medical essentials, connected care, biopharma systems, and interventional and life sciences. Under the medical essentials segment, Becton Dickinson provides a variety of products including peripheral IV and advanced catheters, central lines, vascular access technology, and sharps disposal systems. They also offer medication safety and infusion therapy delivery systems, automated medication dispensing and supply management systems, and informatics and analytics solutions. In addition to medical essentials, the company offers laboratory equipment and diagnostic products for clinical laboratories, pharmaceutical industry, and life science researchers. These include specimen and blood collection products, automated blood and tuberculosis culturing, molecular testing, and microorganism identification and drug susceptibility assays. Furthermore, Becton Dickinson provides surgical products including hernia and soft tissue repair, biological and bioresorbable graft, biosurgery, and other surgical products. They also offer surgical infection prevention, peripheral intervention, and urology and critical care products. The company has a strategic collaboration with ChemoGLO to advance hazardous drug contamination testing in healthcare settings, improving the safety of healthcare workers. With its extensive range of products and services, Becton Dickinson plays a significant role in the global healthcare industry. Becton Dickinson and Co. (BDX) stock has experienced a decline in the past year, with several notable drops. The most significant drop occurred on November 6, 2025, when the stock fell 7.59% after the company reported its fourth quarter earnings for fiscal 2025. Although it surpassed earnings per share expectations, it narrowly missed revenue forecasts and provided an underwhelming outlook for 2026. Another notable drop happened on May 1, 2025, when shares of Becton Dickinson traded sharply lower after the company lowered its full-year earnings and growth outlook with its Q2 fiscal 2025 financials. The stock dropped approximately 5.01% in pre-market trading due to revenue falling short of estimates. The unexpected announcement of a chief financial officer transition on October 16, 2025, also led to significant pre-market weakness, causing the stock to drop around 5.8% in after-hours trading and continuing its decline into the next day. Finally, on February 9, 2026, Becton Dickinson shares fell in pre-market trading due to a significantly lowered full-year profit forecast for 2026. The company revised its adjusted profit outlook downward from previous guidance, primarily due to the completed spin-off and combination of its biosciences and diagnostic solutions business with Waters. These events have contributed to the decline in Becton Dickinson and Co. stock price over the past year. Becton Dickinson and Company market capitalization of $59 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Becton Dickinson and Company holds a significant advantage in their industry. Becton Dickinson and Company trades at a lower price-to-earnings ratio of 34 times and a lower price-to-book ratio of 2.34 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The leverage on the balance sheet appears elevated, with liabilities of 54% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.03%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in the company's performance can be identified from various segments and business operations. On the growth side, the medical segment has shown a significant increase of 5% year-over-year, while the life sciences segment has grown by 3%. The acquisition of Waters Biosciences and Diagnostic Solutions business has also contributed to revenue growth, resulting in a cash distribution of $4 billion. In addition, several product lines have demonstrated growth, including Medication Delivery Solutions, plus 1.4%, Medication Management Solutions, plus 4.2%, Advanced Patient Monitoring, plus 9.3%, Diagnostic Solutions, plus 6.8%, and Biosciences Solutions, plus 15.3%. These increases in revenue are expected to continue in the future. On the other hand, some segments have experienced decline in revenue. The Biopharma Systems segment has seen a significant drop of 14.4%, while the Life Sciences segment has declined by $766 million. The Medical Essentials segment has also shown a slight decrease of 0.9%. Furthermore, lower sales of U.S. point-of-care products and unfavorable comparison to BD-BACT/CTM blood culture product sales in the prior year have contributed to revenue decline. Overall, the company's revenue growth or decline is driven by various factors, including segment performance, business operations, and market dynamics. The net income and profit margins of the company underwent significant changes between 2024 and 2025. The overall net income increased by 26.1%, rising from $303 million to $382 million, primarily due to an improvement in operating income. This increase was also attributed to a decrease in other comprehensive income. Profit margins improved across most segments, with the exception of Medical Essentials, which saw a decline. However, the company's overall profit margin increased from 8.7% in 2024 to 10.5% in 2025. The gross profit margin also rose from 43.3% to 45.9%. These improvements suggest that the company has become more efficient and effective in its operations. The Connected Care segment was a notable performer, with net income increasing by 4.6% despite a slight decrease in profit margins. In contrast, the Biopharma Systems segment saw a slight decrease in net income, while the Medical Essentials segment experienced a decline in both net income and profit margins. Overall, these changes indicate that the company is making progress in certain areas, but still faces challenges in others. The company is indeed generating positive operating cash flow. This is evident from the financial data provided in the summary. On page 5 and 40, it is stated that the net cash provided by operating activities for both 2024 and 2025 are $693 million and $657 million respectively, indicating a consistent increase in operating cash flow. Furthermore, on pages 27 and 41, it is explicitly mentioned that the operating cash flow is positive. This confirms that the company's operations are generating sufficient cash to cover its expenses and investments, resulting in a positive operating cash flow. Overall, this suggests that the company is financially stable and able to meet its obligations. The company's interest expenses have shown a slight decrease over the past 2 years. In 2024, the interest expenses were -$155 million, which decreased to -$153 million in 2025, and further to $153 million in 2026. This indicates a minimal reduction in interest expenses. In terms of debt level, there has been an increase across various metrics. The current debt obligations rose from $1,560 million, not specified year, to $2,623 million in 2025. Additionally, the current portion of long-term debt increased from $700 million on September 30, 2025, to $1,445 million by December 31, 2025. The total debt also saw a slight increase from $19,181 billion on September 30, 2025, to $19,540 billion in 2025. The performance of various segments and regions within the company has been mixed. On a positive note, Medication Management Solutions, Medication Delivery Solutions, and Biosciences have all performed well. Additionally, the BD Medical Essentials segment saw an increase in revenue from $1,586 million in 2024 to $1,595 million in 2025. while Biopharma Systems also experienced growth with a revenue increase from $418 million in 2024 to $429 million in 2025. In terms of regions, the United States and international markets have seen success, particularly within the BD Medical Essentials segment. However, there is limited information available on the performance of Europe and META, Middle East, Turkey, and Africa regions. On the other hand, some segments have struggled. Diagnostic Solutions and Connected Care have both performed poorly. Furthermore, Life Sciences saw a decline in revenue from $836 million in 2024 to $766 million in 2025. The China region has also been impacted by market dynamics, volume-based procurement programs, government focus on compliance, and lower demand for vaccines, resulting in an adverse impact on the company's results of operations. Management is signaling a cautious outlook for the company's future performance. They acknowledge that interim results may not be indicative of the full year, implying that there may be challenges ahead. However, they also express confidence in their ability to sustain long-term growth through strategic investments and operational improvements. To drive revenue and profit growth, management plans to expand their core business, develop new products, and improve operating efficiency. They are investing in research and development, strategic acquisitions, geographic expansion, and new product programs to achieve this goal. Additionally, they are focusing capital expenditures on projects that enhance cost structure and manufacturing capabilities, supporting the company's growth strategy. Management also highlights the importance of adapting to international trade policy-related developments, which may have a continued adverse impact on operating expenses. They emphasize their access to additional short-term and long-term capital if needed, indicating a commitment to maintaining financial flexibility. However, they also acknowledge that implementing new technologies will require additional implementation and ongoing operational costs. Overall, management's outlook is characterized by a mix of caution and optimism, reflecting the company's efforts to navigate challenges while driving growth through strategic investments and operational improvements. The company's financial activities have been quite active in recent years. One notable aspect is its commitment to rewarding shareholders through dividend payments. The company has indeed paid dividends, as mentioned on pages 2 and 40 of the report. In addition to paying dividends, the company has also taken steps to return value to its shareholders by buying back shares. This strategic move is reflected in multiple sections of the report, including pages 5, 8, 10, 32, and 40. By repurchasing its own shares, the company demonstrates its confidence in its future prospects and its desire to enhance shareholder value. Concerns about inventory buildup or supply chain disruption are present in certain areas of the company's operations. In the Biopharma Systems segment, high costs of products sold have raised concerns, page 24. Additionally, market dynamics in China, including tariffs, sanctions, and trade barriers, have led to supply chain disruptions, page 31. Furthermore, international trade policies may impact operating expenses due to tariffs, page 32. Moreover, an increase in inventory levels has been observed in the first 3 months of fiscal year 2025 compared to the same period in 2024, page 40. These issues highlight potential risks that need to be addressed by the company. That concludes the financial summary for Becton Dickinson and Company. Feel free to comment below, and I will be happy to answer them when possible.